Okay, we're at 5, 4, 3, 2, 1. Welcome everyone to the RaaS Research Group Stock Take webinar, where we will dive deep into the analysis of a promising ASX-listed stock. Today, we're focusing our attention on ReadCloud, ASX code RCL, the leading provider in Australia of e-reading software, delivering curriculum ebooks to schools and vet in schools courses, offering over 200,000 ebooks from the world's leading publishers. RaaS Research Group's detailed analysis will be presented by Senior Analyst Graeme Carson, who will cover all the main themes, financial models, and potential pitfalls any scrupulous investor should consider before making an investment decision. ReadCloud CEO Andrew Skelton and CFO Luke Murphy will then provide a detailed presentation of this exciting company. After the presentation, we'll have a Q&A session, which will be live. Please feel free to submit your questions using the Q&A function on your screen throughout the webinar. This is your chance to ask questions of the company and delve deep into the areas you want to know. I'll be collecting these questions and putting them directly to our presenters during the Q&A session. Thank you for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group's Senior Analyst, Graeme Carson. Graeme, over to you.
Thank you, David, and welcome everyone. Okay, so ReadCloud. This is a company that we at RaaS initiated on around about 3 weeks ago, towards the end of July. So it'll be new to many potential investors. So today, I thought a bit of an education piece more than anything was a bit of an overview of the business, how we approach the analysis of a business such as this, and then go into a bit more detail about the specifics and the financial fundamentals and how we go about the actual valuation. So moving through the disclaimer on the next page, which you can look at yourselves, and then onto the agenda. So the agenda itself, we like to look at these things quite sort of holistically. You know, when you start with a micro cap business. So we will look at an overview of the business, a bit of a snapshot, and then we'll see whether we think ReadCloud actually makes sense to us overall. Does it have the products and services and strategy in place to execute on the identified opportunity, and what are the barriers to that? Before we delve into the financial position of the business itself and our forecasts and expectations around the execution of the growth strategy, how we value it, what the valuation looks like, and then a bit of a common sense check and how ReadCloud sits versus its listed peer group of comparable companies, and then some of the sensitivities that may impact our forecast and valuation, and then potential share price catalysts coming up over the reasonably near and medium term, both positive and negative, that may play out. So on to the next slide. So before we go into the business itself, the two tables on the right just provide a bit of a snapshot. You can see the ASX code RCL. The price as of a day or two ago was around 8.5 cents, giving this business a market cap of just over 12 million. But as at 30 June, it had no debt and net cash position of 2.7 million. So the enterprise value is actually less than 10 million. So we're talking very much about a micro cap here. And for that reason, as I said earlier, we think it's important to look at these businesses holistically. Does what they are doing and trying to do actually make sense to us? It's an emerging business. It's small in the context of listed life on the ASX. So let's look at the sort of the overall position first of all. So this is a business that does deliver education services. When I first looked at this business, because it is in its simplest form, an ed tech business, but has got a few more strings to its bow. But this has been listed since 2018. Disclaimer, I have bought shares. I continue to hold shares in the business. It floated in around 2018. And the thing that attracted me originally, I've got school kids at the time, secondary school kids, and they were at school. They were still hauling around these heavy school bags full of textbooks. And when I was buying books every year for them, again, physical textbooks that I had to go and pick up or they were sent to the house. And nowhere else in society did we seem to still be doing this. It seemed to me inevitable that the digitisation in education would have to evolve. And this was one of the only ways that you could really get exposure to it in that sense, certainly in the Australian space. And I don't think there's too many globally driving this either. So first and foremost, on the bullet points on the left there, it is a tech-first business. So it was founded upon a technology that still is the engine room for the overall business now. And it is driving that technology into what is, we think, an inevitably changing landscape. Digitisation generally, as we've spoken of, and then specifically into education, which has been a slower mover in many forms. Also, the way that content is taught these days is changing and broadening, and obviously how content is consumed, especially by secondary school students. I think we all know that that's changing pretty quickly as well. No longer do they just want to sit and look at a physical textbook, and teachers can't just teach like that. There are other content, be it video, be it online, where it's more interactive. Also, students are often now multi-location. We all experienced that through COVID, international schools and the like as well. So what this tech solution provides is an interactive environment across many locations, across many different forms of media that sort of emerges beyond the old traditional textbook type of business. Now, they've also broadened out since then. So this was a founder-led business. Its first product was around 10 years ago. And I think it was around 2013, actually. It has gone through that evolution that micro-cap companies go through, where they've made, some great achievements and probably made some mistakes along the way, or they've just tested different business models with varying success. They have been through that. And the founders are still involved, generally speaking, with the business, but the management team has been built out to find that sort of next stage of commercialization and evolution that a lot of these smaller tech-led businesses have to go through. We see that as a positive. Through that, they have developed a market position, both organically and through acquisition, where the business is now diversified. Don't think just digitisation of old textbooks. There's more to it than that we'll go into. So they haven't put all their eggs in one basket in terms of success. So they've been through this whole thing, and now we think, having looked at it very closely, it is time to scale this business, and they have positioned themselves to do so. So in short, overall, does it make sense on the common sense check and the pub test for us? Yes. ReadCloud as a business and an opportunity, we think does make sense. The next slide is... Okay. So does it have the products, services, and strategy to deliver on this? Sorry, I just can't see the slides there on my screen. So as we said, tech platform is developed. That's the engine room of these three different strategies that the company's now got. Has the tech been developed properly? Yes, it has. The money has been spent on that. It is functioning well. It is proven it can deliver sound commercial outcomes. There are more than 100,000 users on the platform in various forms across these three business units. The first one is ebooks in schools. That's where ReadCloud was born, and the one that I alluded to in regard to digital textbooks. If we look at the pie chart on the top right there, we can see that ebooks generates around 45% of the group revenue. So think of digital books and learning platform for secondary school students. Now, the actual content being delivered is the traditional content in the form that it has generally been provided by third-party publishers. So over 200,000 textbooks are available in digital form and even physical form through this business. But they are delivered across that new platform, that tech learning platform that's collaborative and interactive. So this business is proven. It's in schools across Australia and a few internationally now. So there's an international opportunity there. But it's very early in the scaling life cycle of this business. There's over 2,800 schools in Australia, and I think the ebooks big business is around 65 to 70 schools, and there's around 300 odd in the veterinary schools. So going to veterinary schools, this is still targeted at secondary schools and the students thereof. In this case, at the moment, year 11 and 12 students predominantly. It represents 37% of the revenue of the group, and is focused on not the traditional curriculum students, the vocational education students in the school curriculum. Again, the digital content is delivered across the tech platform, but in this case, it's largely owned. Around 90% of it's owned by ReadCloud itself. They have grown this business through acquisition, through the acquisition of 3 or 4 other businesses that have now all been consolidated and rebranded under the one ReadCloud brand. And we think that can grow just as the ebooks business can grow through adding new schools, and in this case, also increasing the number of specific qualifications that are available on a per school basis. The third business is Vet in Industry. Again, they have entered this market through acquisition. In this case, only one business. This is targeting generally post-secondary school students looking for specific industry qualifications. There is a pretty broad offering here from ReadCloud, but it's actually focused on areas that are largely government funded and areas where skill requirement is really needed. So qualifications, one of the main focuses is early childhood education. If you look at the bar chart on the bottom right there, that shows historically, which is up to FY23, the compound growth rate of revenue has been 42%, organic and by acquisition. Our forecast only issuing 14% compound growth. We don't think that's aggressive, and that is purely organic. No acquisitions are assumed, and you can see the contributions from the 3 different divisions on the bar chart on the right there. So the next slide, please. I can't actually see the slides, but the financial position and forecasts at the moment. So this is a big market, both domestically and internationally. We've spoken about the size of the school market domestically. It's even larger internationally, obviously. But importantly, we think that this business is now at the position where it's well placed to have evolved through that startup phase into the next scaling and commercialization phase. So FY24 is a milestone year for the group. It's a September year end, by the way, ReadCloud. So we're nearly there. The management's guided to underlying EBITDA positivity and operating cash flow positivity. So I'll break even at the EBITDA line. So that is actually for a business of this size, with this enterprise value being, writing revenue of circa $12 million a year, operating profit of $6 million, and EBITDA and operating cash flow positivity. We think it looks reasonably appealing on face value anyway. Costs have also been pulled out of the business in the last 12 to 18 months under new management. So that looks like it's now right-sized from an operating perspective. And operating leverage should now start to push through. And by that, we mean that as revenue grows at that compound forecast rate of 14 to 15%, costs aren't going to grow as quickly and as aggressively. So you get margin expansion in line with that, ahead of that revenue growth number. So we see EBITDA growing at a rate of about 140% from FY24. Keep in mind, it's a very low EBITDA year this year, but we see, the margins growing at an EBITDA line to sort of 11% within 2 years from a break-even position now. And then beyond that, from there. Cash flow positivity, there is going to be some seasonality in the business on a quarter-by-quarter basis, but on an annual basis, we believe the company will remain cash flow positive, and assume that there is no more capital raised to execute on this growth plan. As I said, no debt. Cash will build from September year end this year, and it's self-funded, and it's got growth optionality, we think, across each of those 3 businesses. So should it choose to grow more aggressively with further capital, it will all be growth capital. Next page, please. So The valuation, we think DCF, or discounted cash flow, is the most appropriate way to look at this business. The organic forecast that we've shown illustrate the cash is being generated at an accelerating basis. Our DCF, the metrics of which you can see on the table in the right there, equate to around about 35 cents a share. Again, I reiterate, I think the latest price was in the 8.5 cents or thereabouts. So we don't think we've been aggressive in any of our assumptions or metrics there. The cost of capital makes sense to us. We've associated, we think, an appropriate risk level on the capital because of the size of the business and its life cycle stage. But that said, we also look at some other valuation techniques just to cross-check. One that I personally like is return on equity. This return on equity in this business, as it scales, accelerates, really quickly. Sort of 18% over time. That really drives intrinsic value of the business, and that marries up with the DCF valuation of 35 cents a share. And this is all illustrated in the initiation of coverage. We take you through how we go about these valuation techniques and what the outcomes are. We then do a peer comparison, and I'll go to the next slide if we can. And in this peer comparison, when we look at the universe of the most appropriate ASX-listed comparable companies, you can see, I think there's 10 of them there. The market caps vary markedly across the group. Of the universe, they average out to be 100 million, but very much skewed by the top 3 businesses. Now, a lot of these companies aren't actually profitable, so we do have to look at this on a revenue multiple basis. So we look at it on an enterprise value to revenue multiple. You can see those on the far right column of the table, and that averages out at 1.6 times in the peer group. Now, for ReadCloud, the current revenue multiple on an EV basis sits at around 0.8 times, so around half that of the peer group. And again, it is profitable and cash generative, which a large portion of that peer group is not. So we think from a common sense perspective, it does check out, and the valuation at the moment does look to us like an opportunity. And now we look at some of in the next slide, the key sensitivities and the catalysts. So on the upside case, what is going to lead us to increase our forecasts or deliver profits ahead of what we are forecasting by the business? The ebooks business itself, there's a pretty significant international opportunity there that the company is already taking advantage of. It's getting real traction. Certainly in the inaugural school that began a couple of years ago, you can see that the revenues being generated out of that relationship are accelerating pretty aggressively, and I'm sure the management of the company will speak about that. But we haven't been particularly aggressive in our forecasts there. We just want to see that be proved up. And if it does get proved up, well, then that could be a real accelerant of revenue and profits well ahead of our forecasts. Another assumption, we've been reasonably conservative, we think, in growing the number of schools that the group's adds over the next 2 or 3 years in both the ebooks and the vet and schools divisions. I mean, I think we've got it growing in ebooks from 70 to just over 100, and there was some potential catalysts in place where it could be well ahead of that. And then vet and schools, we're also conservative with both the number of new qualifications and the number of new schools, so that could provide upside. And something we haven't really spoken about is the potential for further acquisitions. It has been something that the company has done in the past. We don't assume that there are any going forward, but if there are, obviously that changes the investment thesis to a degree. On the downside case, I mean, this is a big market. It is full of incumbents, be it the old publishers and the resellers in the traditional book market, and there are obviously some pretty crowded spaces in the vet and industry part of the business. And schools in the schools part can be quite slow moving. So, there is a risk that either, schools aren't ready to adapt this now as quickly as we think, or there is a very strong response from competitors or incumbents in the industries, even from a digital perspective. So that is those are definitely risks in terms of the execution. But I'm sure management will be able to speak to some of the mitigants of those as well. Finally, the catalysts that we think might drive the share price. Keep in mind, catalysts can be both positive and negative. I think the first one would be a materially negative catalyst if there was a guidance miss at the end of FY24. Now, by guidance miss, we don't mean 100 or 200,000 here or there. We mean a reasonably material miss, and the key points there are going to be that EBITDA number, which is supposed to be underlying break even basically, and a positive number at the operating cash flow line. So we'll be looking for that as the first tick, and then potential positive catalysts, as we've said, proof of traction internationally. Whether that comes through in the current result or in periods forthcoming, time will tell. Again, another potential catalyst is the domestic selling season. So this company is seasonal in terms of businesses. Like the schools only make their decisions at certain times of the year, as you can imagine, and they make it for the upcoming year. So the selling season is ahead of them in the not too distant future, and the outcome of that can give you pretty good forward guidance on what the year ahead looks like. Impressively, the group did retain a lot of its ebook customers to the tune of 90% last year, which was well up from previous periods. So new management have done a great job there. The other thing is FY25 and onwards, whether management are willing to talk about forward-looking statements. They have said that they can grow these businesses, they think, at the top line organic rate of 15% per annum, which is around where our forecasts sit. So that's pretty impressive. So if they can deliver that, I think the market will take that well as it evolves. And then finally, a catalyst could be M&A activity, as we have previously said. So that's it from me, and I'll be around at the end to take any questions that people have. David, so back to you.
Thanks, Graeme. A detailed analysis, and I think really sets the scene for the next part of our webinar, which is the presentation from ReadCloud executives. Now, remember, a copy of the research that Graeme has produced, an extensive research that he has produced, can be found on the RaaS Research Group website, and we will be aiming to send a copy of it to each of you. Now it's time to hear directly from ReadCloud CEO Andrew Skelton and CFO Luke Murphy. Please join me in welcoming Andrew and Luke. Gents, over to you.
Thank you, David, and thanks everyone for joining us. It's great to be here. So I'm Andrew Skelton. I was brought in just over a year ago to ReadCloud, really to unlock the growth potential in the business and to bring some discipline or add some discipline to our execution. So I've been focusing on simplifying the business, removing friction, and best of all, getting us closer to our customers. And those things are now paying off in the form of, we've got a really healthy sales pipeline and much stronger retention as well. So, it's a rewarding space where we operate. Australian school students and Australian teachers are really the key beneficiaries of what we are delivering. And we're not exposed to the economic cycle, we're in education. And we're not exposed to the politics around international students. The other industry that we're exposed to is really childcare, and there's a lot of favourable, quite strong tailwinds in that space as well. So look, we really like being at ReadCloud, and I'm thoroughly enjoying it. And we're joined today by our CFO, Luke Murphy. And Luke's been really at the helm of ReadCloud for 4 years. I'm not sure if he's enjoyed all those 4 years as much as I've enjoyed my first one, but he's here and he's been instrumental really in integrating the 4 registered training organisations that have been acquired by ReadCloud in that period. So if we turn to our presentation, we've just got some slides here. And again, Graeme sort of covered this, but just to give you your bearings on where we're at, the things I like on this slide, we've got an established and a strong board. We've got a healthy mix of shareholders with board and management holding 22%, and we've got strong support from investors like Thorney and Micro Equities and some others. So, and look, to be frank, we've got a valuation that can be perhaps described as undemanding. You know, our market cap today is around 12.3 mil, 2.7 of cash. So, you know, as Graeme pointed out, the enterprise value is less than 10. So we think that's a pretty, well, we're quite excited about launching from this point. So if we move into the next slide, we set out what we do in the next slide, and we provide education services to Australian and international secondary schools and vocational training to Australian schools and Australian industry, particularly in childcare. So we own and operate a software platform that students and educators use to access content. They use our technology to access their learning materials. Our platform is an open platform, and we distribute content from more than 40 publishers, including the world's leading publishers of school books. And we leverage that same platform to deliver the content that we write and own ourselves, particularly in vocational training, and that gives us the competitive advantage that we have in vocational training in the schools sector. So we sell school books. We deliver vocational education and training to high school students, and we deliver vocational education and training to Australian industry, especially childcare. So looking at what we're focusing now, we've set this out for you on slide 4. On the next slide, you can see that it's an established company. It's been around for a while. And what we've done recently is optimize our margins and put things in place to understand and unlock the operating leverage in the 3 businesses. So we can now make a genuine assessment of our organic growth options. And this has put us in a position to allocate capital and effort and to execute with confidence that we are generating meaningful results. And you can see on that slide, look, we're really confident in targeting that 15% compound annual growth rate in profit. Really confident in that sort of, we use that as a baseline, and we've got our costs growing at a far slower rate. So we like the spot we're in. If we look specifically at the revenue growth, we've got it for you on the next slide. So you can see things are moving here, and they're moving in the right direction. In terms of revenue, you can see an established pattern of growth, and that growth is now evident in strengthening operating cash flows and improvements in underlying earnings. Also moving in the right direction of costs. You know, our operating expenses are 4% lower than last year, and our first half salaries and wages in ebooks and vet in schools, being the businesses that support 80% of our revenues, were 11% lower than last year. So how do we drive growth from here? We've set out some pointers on the next slide, and you can see, well, you can see there our growth, our gross margins, and they're pretty good, particularly in vet in schools. I mean, that's quite a stunning, really scalable business, gross margins really high. And that sort of comes back to that technology platform that we share across the board, and that sort of leadership position we've got in sort of content creation and getting closer to our customers. In ebooks, you've got a kind of more standard retail margin. We really are just selling books and passing them through. So that scales really quite well, that business as well. So we're not sort of perturbed by the lower gross margin in there. We just certainly celebrate the margin in the vet businesses. Now we're on track for a breakthrough positive underlying EBITDA and positive operating cash flow in FY24, which, just reminding you, September 30 year end. So that's well within striking distance, and looking forward to updating the market once our full year closes off. Our sort of business as usual, or our baseline revenue growth target is 15%. We've got a stable fixed cost base. So, you know, we like that momentum in the business. So if we turn to the next slide, you can see what we regard as the catalyst for the organic growth, and that's selling books to more schools, including international schools. It's becoming an approved supplier of school books to New South Wales government schools. Now, earlier this year, we won the approval to sell technology into the government sector in New South Wales. There's a separate approval required to sell the learning materials or the books into the government sector in New South Wales, and we will get the result of our efforts there in September. That's scheduled for. So I'm quite excited about that new market. We're also, what we can do right now and what's taking shape quite well is upselling and cross-selling our vet courses to the existing customer base. And we expect a notable uplift in that cross-selling or upselling of vet courses in 2025. Now, we're extending our market reach into new locations. So, we've been particularly strong in Queensland in school books, and we've been particularly strong in New South Wales and Western Australia in vet or vocational training in schools. But for example, we've got a good sort of beachhead into Northern Territory, and on the back of some quite promising government partnerships in the NT. We've also got a beachhead that's been established in Queensland schools for vocational training. And we can extend what we do, which is currently targeted only at Year 11 and Year 12 students. We can extend that into Year 10. So we anticipate those Year 10 products maybe beginning to come online in 25, in the school year 25. But certainly there's quite a bit of interest in getting things up and running in 26 at a number of schools. And look, childcare is there's lots of government support going into childcare. There's sort of some favourable demographics behind it too. And we've got a track record now that we've established, well, certainly in the last sort of 6 to 9 months of building partnerships with sort of key childcare groups, and we expect that will continue. So just finally on slide 8, we've highlighted here how we are set up to strengthen and grow ReadCloud. So we're seeing the re-emergence of tailwinds for digital education. And what I mean by that is that COVID restrictions on schools essentially forced a leap into Zoom or Teams or other alternatives. And schools kind of thought they were digital as a result. But when you actually look at it, as the materials are changing and teachers and students are using a wider range of sources to teach and to learn, and we are really nicely positioned as an open platform and as a digital first platform. We're really well positioned to sort of harness that transition into genuine digital education. And in 2026, the Australian curriculum resets, and that's going to generate another bump in sales for us in that year, where basically all the schools have to refresh their entire libraries. So those things are helpful. In vocational training, we're cementing our place as a leading private provider of training courses for schools in Australia. By private provider, you should think about it in terms of a school has 3 choices when they're delivering vocational training. And there's more than 250,000 kids a year doing vocational training in high schools in Australia, so big market. The school either becomes an RTO, a registered training organisation itself, and has to deal with all the regulatory requirements and administrative requirements and ASCA audits and on and on and on. Or the kids are sent off to TAFE once a week, or sometimes a little bit more, but that has, obvious sort of downsides. Not least of which is a TAFE isn't really geared around teenage students or high school students. Or the school says, okay, don't want to send the kids to TAFE. I can't get my head around all this RTO, this regulation work, or even if I can, I want to offer more courses and I don't have the capabilities to keep expanding my scope. And that's a real strong point at ReadCloud. One really concrete advantage we have is that we offer by far the widest range of qualifications in the market. And we're now putting ourselves forward as a coordinated one-stop shop rather than as 3 individual training organisations that are servicing schools. So that's been quite an obvious and natural step for us to take. And that, I think, is going to have quite a significant uplift for us in 2026. So I mentioned 3 training organisations there. The 4th one is the one that services industry, and then particularly childcare. So look, as a company, we're now self-funding. And we're leveraging our proprietary technology across all three categories, and we can now begin to accelerate organic growth by reinvesting that improving cash flow into the existing business. And we can even begin to turn our minds to further acquisitions that stack up. So Luke and I are very happy to be at ReadCloud and driving a growth agenda. I'll now hand back to David and look forward to answering any questions.
Thanks for the great presentation there, Andrew. An insightful presentation and really a great deep dive into the ReadCloud business. Now, as I said at the beginning, this is your opportunity to ask questions live of our presenters to really get a greater understanding and delve behind the presentation. So please submit your questions using the Q&A button on your screen, and I'll be putting these questions directly to Andrew, Luke, and or Graeme, depending on who they come through from. So we'll jump straight into it. A question has just come through. What is the opportunity with the New South Wales DET accreditation?
The opportunity for us is to be able to sell into New South Wales government schools. That should be a good market for us. We can sell, there's three kind of main sectors. There's the government schools, there's the private schools, and there's the Catholic school system. So at the moment, we're not entitled to sell into the New South Wales government school system, and we're looking at breaking through that barrier during the remainder of this year. We're halfway there with the tech. We've just got to tick the other box, get the approval to sell learning materials.
And Graeme touched on the retention rates and how they've significantly increased in certainly the last 12 months. Do you think you can keep those retention rates at the levels they're at now in relation to domestic schools in ebooks? And then how do you attract new schools?
Yeah, so we target 93% retention rate. That's our target. And I'm really confident we can do that. Being an agnostic platform that's digital first, it's just different. Everyone's trying to bottle you up into one publisher stream or, different logins to access content. We're one. Far more user-friendly for teachers that want to augment learnings with, videos or other sources. And we're much closer. We're just listening to our customers. We're engaging with our customers in a much more sort of structured, regular manner. I think retention doesn't stress me at all. Those relationships are strengthening. In terms of new sales, I think it comes down to credibility. And the best thing about that is if you retain really well, it's really hard not to grow. So we're providing quite good services to librarians or to principals, and they're different but you've got to have a different message for the different buyers of the service. We've started figuring that out. And as people move around in their careers, they're moving from school to school. We're now actually getting a baseline of that credibility and that relationship, which is starting to, it's just starting to broaden us up. Like we've got more inbound, we've got a number of inbound inquiries at this time of the year, which, going back 1, 2, 3 years was not typical at all. So just by being more present in the market, by engaging better with the customers, by taking the learnings and then sharing the success stories with our network of schools, that seems to be feeding quite well into our sales pipeline.
A couple of questions here in relation to international schools and probably the size of the prize, if you like. So I'll group them together. What's the process of selling ebooks to international schools? And what's the size of the opportunity you think you have in your existing pipeline?
Yeah. So the process, if we look internally, the process is exactly the same as for an Australian school, save for one thing, which is you possibly have different books. It's likely to be a big overlap in the publishers that you use. So publishers, think of Jacaranda is big in Australia, or Oxford University Press, Cambridge University Press. There's more and more sort of online publishers coming up, Pearson. Now, those sort of publishers generally are global. So you might need different variants of books. So you've got to bring them into your system. You might have different licensing arrangements from the publishers that you have to engage them in different cities, but the tech is exactly the same. The process is exactly the same. And in terms of winning the opportunities, it's really about fronting up, engaging with schools. We could be more active in that space. We're spending very little on marketing. We're spending very little on sort of travel and being present. We have won, in recent times, 5 international schools. And what we want to do, whilst we've been determined to generate that positive EBITDA or the positive underlying EBITDA this year and the positive operating cash flow, we've been quite circumspect with how and when we're spending money. Right, so we've got our 5. We're trying to build them up, scale them up. There may be a little bit of referral work, or some we anticipate, but it's really about nailing those so we can figure out which ones do we target most effectively. There's 12,000 international schools in the world, and that's kind of defined as schools that teach in English language that aren't local schools, and that's useful for us because that's where we're strongest. So we've already figured out if you have kids in multiple locations and one of our schools has students in 62 different countries, we are literally perfect for that. They don't have a practical solution for getting the right kid into the hands of the right book into the hands of the right kid at the right time. We have that absolutely nailed. It's really hard to do that if people are sourcing remotely or sourcing, I mean, heaven forbid you're trying to do that from local bookstores. Or the other one is servicing schools where there's not ready access to books. And there's quite a few schools in that category. So we've won recently, one in the Ukraine and one in South Africa, which again, just had some challenges in its local geography. So we've got those sort of dynamics. We've got the Australian International School in Singapore starting to build out its library with us beginning in the next school year. So really, we just want to take our learnings, get the strong sort of rapport and understanding of those customers. Then we can figure out, well, where do we target with the most effective bang for buck on our marketing spend and effort.
And what is the sales strategy for getting more VET courses into schools? Is it by individual school or region, or share, or is it a state education department?
Yeah, it's not department based, which is good, although the departments have been impressed with some of the initiatives we've taken around, professional learning for teachers. We've got some great kind of CPD or professional development programs for teachers. So they can be promoted by schools. Industry Guides is another initiative where we've put together a bunch of information on 19 different industry areas, being the ones that we kind of educate in. And it gives students and their parents an insight into, well, here are some of the learnings and some of the strengths and some of the natural skill sets. If you're interested in this, here's what a day in the life of looks like. Here is what a career looks like. Here's what some likely earnings information is. Those industry guides have proven quite popular, and initiatives like that, they sort of raise our profile with the state, with the government bodies, and sometimes that material is dispersed. We do work in clusters. Often schools work in clusters. Not every school will have a chemical lab for sort of measuring or measurement, which is one of the courses, or they won't have, the facilities they need for a skin, hair and beauty course. So we work with them to help coordinate, well, your kids can go within a region to this school and these facilities here and that. And so it can be at that cluster level, but in the main, like, it's a big market. There's lots of opportunity for us. As I mentioned, I think there's over 250,000 kids a year. We're doing about 14 or 15,000 a year. So there's a lot of upside. And again, there's this sort of real awakening in the market. I mean, ReadCloud Vet is quite young, right? In the last sort of 3 or 4 years, we've put together that offering. This is really the first year we're promoting it as one business covering 49 different qualifications. So people are quickly realizing, oh, you mean I don't have to deal with 3, 4, sometimes more individual RTOs. I can have a one-stop shop, and your tech's good, and your materials are good, and your service is great. We do really expect an uplift in the number of qualifications we deliver into each school. That's increasing kind of our, just awareness of the brand, the technology. People are becoming comfortable with it. We're making it better as we go. There is quite a bit of referral work that we anticipate in that space.
Luke, it might be a question for you. Seems to be some seasonality in cash flows, but do you expect to remain cash flow positive on an annual basis from full year 24 onwards?
Yes, we do. Operating cash flow. As you've observed, David, our cash flows are very cyclical, given that 2 of our 3 operating businesses are exposed to the school year cycle. So very much our ebooks and vet and schools businesses, peak cash inflows are in the March and June quarters, as you'd expect at the start of the school year. Industry training and is more even across the year in terms of cash flows. And international schools, that's helped smooth out some of the cyclicality of the ebooks business, because a lot of our international schools are in the Northern Hemisphere and are on a different school year.
And in terms of the competitive environment, Andrew, maybe one back for you. Who do you compete with? And are you competing on price or features or a mixture of all of those things? And particularly in relation to New South Wales Ed, what's the competitive landscape look like?
Yeah, thanks, David. So competition in ebooks, we compete with Campion and we compete with Box of Books. And there's a number of other sort of small players as well. There's a reasonably long tail. Now we compete on service. It's really easy and it's really simple, and we're kind of having some fun with it now. And I say that because the price, it's the same book, essentially at the same price. So we're procuring that book through our arrangements with publishers. The publishers have an RRP, and there's a margin on that book that we can keep or claim or play with, and that's pretty standard across the group. So you're really selling the same book essentially at the same price, and we win on service. It's helpful that our tech is better because, again, we're digital first. So we haven't come out of a warehouse environment where we're packing books into boxes and then distributing them and saying, oh, but we've got a Me Too digital thing. We're actually digital first. So for the schools that are taking that lead or have already crossed into the digital world, we're really well placed. That's the competition in selling the books into schools. In the vet in schools, the vocational training in school space, remember, the schools can do it themselves. It's probably declining. We're getting a sense that's declining. There's a lot of money being spent in TAFE, but it's not directed in the school sector. If anything, it's kind of pushing the schools. The schools are less inclined, we're sensing this year, to send the kids off to TAFE. TAFEs are different, kids are different, and it's not a young teenage environment at a TAFE. And there's the logistical things as well. And so really we're left in that sort of private provision of vocational training into schools. We compete with businesses like iVet would probably be one of the bigger ones that we compete with. Otherwise, it's quite cottagey and targeted on individual quals. So none of them are close to offering 49 different qualifications. So we have a clear advantage there. I think we have some pricing power. I mean, we're very confident about delivering our 15% growth, and I think pricing power, we can get a little bit better at that. I don't really get the sense we're competing on price very much in that space. And in our training for Australian industry, again, mainly childcare, one of the advantages we have, being sort of a more established, bigger footprint, better technology, obviously, better backing, behind the scenes. But we also have funding arrangements in place in Queensland, in New South Wales, in Victoria, and in South Australia. So if you're a national childcare operator, right, it's quite hard to find a registered training organisation that can train your staff, which is beneficial for you for 2 reasons. One, as your childcare staff become more qualified, it changes the ratio of sort of staff to children. So it improves their economics. And in terms of price competition, there is none the government pays for that training. Right? So competitively, I think we're reasonably well placed. We just need to engage with our customers. We can, and we do seem to be winning on service. And I think you can sort of get some confidence around that from the increase in retention.
I'm going to throw two quick questions to Graeme, and then Andrew will come back to you for the final question or so. Graeme, do you think your revenue growth forecasts, and keep in mind they're your forecasts, they're not the company's forecasts, are conservative or aggressive? And second, do you think the company needs capital to fund growth?
Yeah, thanks, David. Look, I think you've heard the confidence from Andrew there in terms of delivering the 15% growth at the top line as the business stands. We haven't been any more aggressive than that. That makes sense to us in terms of what, from our research, it looked like what the runway is, and a very realistic assumption around number of new schools added, specifically domestically, and growth in the other underlying businesses. They're all retaining their customers, and there's pretty good organic growth rates in there. So that will be a self-funding position to deliver that 15% growth at the top line as we see it. But then the company does have optionality, we think, to accelerate growth in any one of those three chosen businesses if they see fit. Now, to do that, they may want to raise capital, but unlike a lot of microcaps, it'll actually be genuine growth capital if they do choose to do it, rather than sort of stay alive or working capital. So no, to get to that 35% DCF valuation, we issue no more acquisitions, no capital raised, and we're reasonably conservative on our assumptions. But I mean, we're not willing to go out and take any big punts at the moment because we want to see it play out. But I'd be surprised if this is what the business looks like in 3 years. I mean, I would assume that the company will be more aggressive in one form or another at some stage, but that's impossible to forecast. The good news is that it's got a nice cash generative base to build from, I think, is the message.
Thank you. And Andrew, final question, growth. What does it look like? Is it organic growth? Does M&A play a part? Do you start mopping up some of that cottage industry as you discussed? And if so, what does the focus look like?
Yeah, thanks, David. Look, we've been really myopic in the last 12 months on putting our best foot forward with what we have and standing on our own 2 feet, funding ourselves, being able to begin to invest back in the business, create the brand, create the expectations around service and engagement. Right. So we haven't been keeping an eye on acquisitions or corporate action during this period. It's really been about, you know what? Enough's enough. We're now going to stand and deliver. We're going to get through FY24 with positive underlying EBITDA and positive operating cash flow. We're going to do that. Right. So in that context, and really bringing the business closer to its customers, we haven't sort of been looking further afield. Now, I think as we get more and more of these foundations in place, and as the culture embeds and it embeds as the ReadCloud culture, rather than the 5 different businesses being the original ebooks business, the first 3 registered training organizations, which were school focused, and the registered training organization was industry. We brought together 5 businesses, right? We want to establish the ReadCloud culture, get close to customers, win on service, really strong retention, build up that pricing power, because we are leveraging better technology and better sort of back office support than any of our cottages type sort of competitors can deliver. Now, I think what happens as we build this thing and as it locks in, it's then incumbent on Luke and I and our board, in fact, to look at, well, how do we accelerate? Now that we can fund things off a much better footprint, I mean, how do we accelerate this? How do we make use of that culture, that technology, that service mindset, the actual customer footprint? I mean, it would be quite useful to bring in, it's very now easy for us to roll up more registered training organizations, but we want to do it in a way that's, really enhancing the returns rather than sort of distracting us from the organic growth, which, look, I'm actually really rapt that we're going to have a 15% baseline in growth and our costs are growing much more than that. And we're already, or by the end of September, we're through the gate of being positive cash, positive underlying EBITDA. I think that's a really important baseline for us to lock in. But the time is coming, yeah, where we will have the flexibility and I think the credibility to start making some plays to really accelerate on top of the organic.
Thank you, Andrew. That was a great answer. And that does bring to an end our Q&A section today and the formalities of today's webinar. Thank you, everyone, for your participation and great questions. Thank you, Graeme, Andrew, and Luke for presenting today. I'd also like to thank each of the attendees for your participation in the webinar and engaging in the Q&A. We hope you found this webinar informative and valuable in helping you make investment decisions. We look forward to seeing you at our future events where we will once again dive deep into the analysis of another promising ASX stock. Thanks to our presenters. Thanks, guys.
Thank you, David.
And
Thanks for having us.
attendees. Thanks, everyone, and have a great day.